Reaching a six-figure income is usually a result of intense personal labor. It requires years of discipline, specialized skills, and a schedule that leaves very little room for anything other than the grind. But scaling from that baseline to extreme wealth requires a total detachment from your own labor. To move past a comfortable salary, you have to stop being the engine of the business. If your income is tethered to the hours you spend at a desk, you are on a financial treadmill. No matter how high your hourly rate goes, you are still trading a finite resource, time, for a paycheck that eventually hits a ceiling. Escaping this cycle depends on a shift in focus. Instead of working for a wage, the wealthy prioritize the acquisition of automated systems that function regardless of whether the owner is present. Consider the vending machine. While most see a simple side hustle, an investor sees a physical node in a high-traffic area that functions as an unmanned 24-hour cash register. These units require minimal oversight. With low inventory costs and steady foot traffic in locations like gym break rooms or medical clinics, independent networks can maintain profit margins between 60 and 70%. The digital version of this model is software as a subscription. Because the cost of duplicating code is zero, a single piece of software can be sold 10,000 times without a single new unit ever being manufactured. Once the infrastructure is built, these platforms route monthly recurring revenue into the owner's accounts. The code performs the service, the billing system handles the collection, and the human owner remains outside the loop. At this level, wealth is built by building automated transaction funnels. You replace active management with hard-coded systems that capture and process revenue. To reach the highest tiers of wealth, investors move into private equity. This system involves buying established, profitable companies, restructuring their management, and eventually selling them for a much higher valuation. This strategy traces back to tycoons like J.P. Morgan, who used pooled capital from outside investors to buy and merge companies, forming massive corporations that dominated their respective industries. Modern firms often use a leveraged buyout. They borrow massive sums to acquire a company, but instead of using their own assets as collateral, they place the debt directly onto the balance sheet of the company they are buying. When Blackstone acquired Hilton, they installed new leadership and shifted the focus toward brand management. When they finally exited the investment, they walked away with $14 billion in profit. However, the same mechanism can be fatal. Toys R Us was purchased using massive amounts of debt that the company could not service. Between interest payments and management fees, the business lacked the cash to compete and eventually filed for bankruptcy. These systems favor the firm, regardless of the outcome. They collect millions in management fees while the target company operates, ensuring they profit whether the business thrives or collapses under the weight of the debt. Large fortunes are notoriously difficult to maintain. Statistics show that 70% of wealthy families lose their fortune by the second generation, as heirs often lack the skills to manage the complexity of the estate. To prevent this, the wealthy use trust funds. By transferring ownership of assets to a legal entity with strict rules, they ensure the money is preserved and that it is not subject to standard estate taxes. When an estate lacks this architecture, the result is legal chaos. When Prince died without a plan, his assets were tied up in court for years, with a significant portion of his wealth lost to taxes and administrative fees. Many choose to house these entities in offshore tax havens. At Ugland House in the Cayman Islands, over 20,000 corporate entities are registered to a single 5-story building to take advantage of favorable privacy and tax laws. This creates a legal distance between the individual and the wealth. If a trust or a foreign shell company technically owns the mansion and the yacht, the individual legally owns nothing, and therefore owes nothing in taxes. High-earning CEOs often avoid standard salaries because labor income is taxed at the highest possible rates. They instead rely on a strategy designed to generate cash without triggering a tax event. The first phase is to acquire assets that grow in value over time, like stock equity or commercial land. As long as these assets are never sold, no capital gains taxes are ever due. Instead of selling, the owner takes out a low-interest credit line using their portfolio as collateral, providing millions in liquid cash tax-free. When the owner dies, the step-up in basis loophole resets the asset's value to market price, legally erasing decades of taxable gains. This strategy allows wealth to compound indefinitely, paper gains remain untaxed, while the credit facility provides cash to fund a lifestyle for generations. Most people operate in a labor economy, where income is taxed before it reaches the bank, and debt is used for consumption. The ultra-wealthy operate in a system economy, where equity grows untaxed, and debt is used as a tool for leverage. Transitioning into this second economy requires a shift from chasing a higher salary to acquiring your first automated, cash-flowing business. We examine the specific architectures used to build and protect these wealth networks. Subscribe to the channel to see how these systems are constructed. Focused on moving from a paycheck to a system? Write wealth in the comments below. Reaching the highest levels of the ladder is not a matter of working more hours. It is a matter of owning the systems that do the work for you.